Good morning, everybody. Mike Vacchi from Princetontrader.com for ntmarkets.com with your Tuesday morning pre-market webcast. Okay, yesterday, big down day in the market. You started to see, after we did these two days outside of the third standard deviation Bollinger Band, we're trading at 5-year highs. And despite that, a lot of people wanted to buy. People looking for 1605, people looking for 1625, and we're 2 days into the third standard deviation band. I mean, we've completely left the bands, traded completely outside of the bands. We talked about this last week, and that is simply not sustainable. And so, Friday we started to see some signs of weakness. Continued to bounce off that key 75-76 level. But what we saw yesterday was pre-market in our room, we said 1578 is your risk marker for the day. Meaning, if it goes over 78 and you want to be short, you need to rethink that. And that stayed solid all day. 1576 was our kind of magnet level. Price was kept moving back up to 76, trying it, couldn't do it. Did it a couple times in the morning. Finally, the bulls just kind of had to give up on it, and we started to trade lower and lower. And unfortunately, into the afternoon, we had a horrific catalyst in Boston that helped us sell off even further. And our hearts go out and prayers go out to everybody affected by that. Just a terrible thing. What we're seeing now in the Globex is we've traded as high as 1555. We've got a triple pivot zone that runs from 1554.83 to 1556.33. So we've kind of traded back up into those triple pivots. The bears need to keep it under the green line, underneath the middle band. The middle band broke hard yesterday. They closed well below it. They need to keep it above them as resistance. If the bears want this to be real, a real genuine pullback, they need to continue to follow through. And they need to break down through 1533 and close below it. 1533 is the low from April the 5th. That was the jobs report. Additionally, you've got the 50-day exponential moving average, and there's some fib levels down there, and then you're down into the lower Bollinger Band. Those areas need to be taken out, and they need to stay price needs to stay under them and create that as resistance. If that happens, then you begin to open up areas like 1510. But let's not get ahead of ourselves. The job for the bears today is to keep price underneath the middle Bollinger Band. The job for the bulls is to close above the middle Bollinger Band. If they can do that, then this move starts to look like a 1 or 2 day anomaly, and maybe they can push back up to price. What I started to see yesterday, which happens every time, is we trade from 1593 where nobody wants to get short. Third standard deviation Bollinger Band, nobody wants to get short. Everybody's looking higher off of multi-year highs. And it's not until we trade off literally 40 to 50 handles when we're down on 1543 to 1553 when you start to see on Twitter and other places people talking about, well, maybe you need to take some profits. Maybe this, there's uncertainty in the market. Come on. 40 or 50 handles later, it's over. That's not the time you want to think about selling. Okay? And what we've done off of that, down in the 38.75s is we've gone ahead and done, 15 handles up. So if you're looking to short this market, you need to use that triple pivot area as an entry, and you need to use the middle Bollinger Band as an area where you're going to be wrong. If you're going to do it, you need to do it in a risk-sensitive way. Otherwise, you're going to be shorting 40 or 50 handles in the hole because you feel like you missed out, and don't do that. Okay. That's all I've got for today. Mike Vacchi, Princetontrader.com for ntmarkets.com. I'll be back tomorrow morning with another webcast. Trade them well, everybody.